Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial jargon so you don't have to. Today we're diving into Consensus Cloud Solutions' latest quarterly report. And let's just say the numbers are telling a story, but is it a happy one or one that needs a bit more re-editing? Before we get into the nitty-gritty, if you love getting these decoded insights, smash that subscribe button. And for even more in-depth discussions and to connect with fellow finance fans, join our Discord community, linked in the description below. Consensus Cloud Solutions, a company in the secure information delivery business, has just put out their report covering the period ending June 30, 2020-2025. They had about 18,970 specific number, and it gives us a baseline for understanding ownership is 7,018 shares of their common stock outstanding. That's a pretty specific number, and it gives us a baseline for understanding ownership. Let's jump straight into the financial heart of the matter, the condensed consolidated balance sheets. This is like a snapshot of what the company owns and what it owes at two specific points in time. June 30 Henflosh D of 1324 on the asset side, meaning what they own. Cash and cash equivalents saw a healthy jump from $33.5 million. Tundra's equivalents saw a healthy jump from $33 million. By June 30th, ones saw a healthy jump from $33.55 million at the end of last year to almost $58 million by June 30th. That's a good sign, showing they have more readily available money. Accounts receivable, which is money owed to them by customers, stayed pretty flat around $24.8 million. That's not necessarily bad, but it's not growing much either. Now here's a big number, goodwill. As of June 30th, 2025, it stood at a massive $352.7 million. Goodwill is essentially the premium a company pays over the fair value of a business it acquires. A high goodwill number can indicate a history of acquisitions, which can be good if those acquisitions are successful, but it also means a large chunk of their assets isn't something tangible they can easily touch or sell. Overall, total assets grew from about $602 million to over $641 million. That's an increase driven partly by that goodwill figure and the growing cash pile. Now to the flip side, liabilities and what they owe. Total liabilities actually decreased slightly, down to about $661 million at the end of 2024. Their long-term debt is a significant number, sitting at $578 million. This is money they owe that isn't due in the next year. So liabilities are substantial compared to their assets, which is why we see a stockholders deficit. This means that if you added up all their liabilities, it's more than what their assets are worth. This is seen as a negative equity situation. The total stockholders deficit improved, moving from negative $79.5 million at the end of 2024 to negative $26.5 million by June 30, 2025. That's a positive move, meaning they're reducing that deficit, which is good. Let's look at how they performed financially in terms of income. For the 3 months ending June 30, 2025, revenues were $87.7 million, virtually unchanged from the same period in 2024, which brought in $87.5 million. Gross profit, which is what's left after paying for the direct costs to provide their services, also saw a slight dip from $70.4 million in the second quarter of 2024 to $70 million in 2025. So they're bringing in about the same amount of money, but making slightly less after covering those direct costs. Total operating expenses, which include things like sales, marketing, and general admin, actually decreased slightly from 2024 to $31 million in 2025. This resulted in income from operations of about $39 million for both periods. So while revenues and gross profit were flat, they managed to keep their operating costs relatively stable. And the bottom line, net income was $28 million for the 3 months ending June 30, 2025, down from $23.9 million in the same period of 24. This drop in net income is important. Even though revenues were flat and their operating costs were managed, they made less profit. This could be due to various factors like increased interest expenses or other costs not directly tied to providing the service. Diluted earnings per share dropped from $1.24 in the second quarter of 2024 to $1.07 in the same period of 2025. This means each share is now earning a little less. Now for the cash flows. For the first 6 months of 2025, they generated $69.2 million in cash from operations. That's almost identical to the $69 million they generated in the same period of 2024. This is a pretty stable operational cash flow, which is good. On the investing front, they spent $15.2 million on property and equipment, which is a bit less than the $17.5 million spent in the first half of 2024. They also purchased $5 million in investments in 2025, which wasn't there in 2024. Financing activities show they spent about $12.3 million on repurchasing their own stock in the first half of 2025, compared to less than $1 million in the same period of 2024. They also repurchased debt, spending nearly $28.6 million in 2025, a significant drop from the $86.1 million spent in the first half of 2024. Those debt repurchases are a major reason for the lower cash outflow in financing for 2025, a significant drop from the $86.1 million spent in the first half of 2025. Looking at the statement of stockholders' deficit, we see the impact of these repurchases. Their treasury stock, which is stock they bought back, increased significantly. For example, the amount spent on treasury stock went from $32.3 million at the end of 2024 to over $44.8 million by June 2025. This shows a deliberate effort to buy back their own shares. The number of outstanding shares decreased slightly, which would be expected with these buybacks. In terms of equity incentive plans, the number of outstanding restricted stock units was about 2.1 million at the start of 2025, and it dipped slightly to just under 2 million by June 30th. They also have about $29.6 million in unrecognized share-based compensation costs expected to be recognized over the next couple of years, which is a future expense to keep an eye on. The company operates one reportable segment, CloudFax. Revenues for this segment were pretty much flat. The big news here is that their corporate segment revenue actually grew by 7% for the quarter, while their small office, home office, or SOHO segment saw a 9% decline. This shift in revenue from SOHO to corporate could be part of a strategic move, focusing on larger clients. Their monthly churn percentage, or the rate at which customers leave, increased slightly for both corporate and SOHO customers. While the overall churn isn't alarmingly high, any increase means they need to work harder to keep their customer base growing. Digging into expenses, sales and marketing costs went up by about 6% for the quarter, mainly due to more spending on third-party advertising. General and administrative expenses decreased, which is generally a good sign. This was helped by lower bad debt expenses and less depreciation. Now, let's talk interest. Interest expense was stable for the quarter, but increased for the 6-month period. This is partly because they had a loss on debt extinguishment in 2024. So while they repaid debt, the accounting impact meant higher interest expense for the first half of the year. Interest income declined because they say they decreased their investments in money market funds, likely to fund their stock buybacks and debt repurchases. This makes sense. If you're using your cash for strategic moves, you earn less on idle cash. They also reported a significant gain from foreign currency translation. This means their international operations, when their financial results are converted back into US dollars, are looking stronger due to exchange rate movements. Looking at liquidity, their operating cash flow remained very strong and stable, which is a crucial indicator of a healthy business. And in a significant subsequent event, they announced a new, larger credit facility in July 2025, totaling $75 million for revolving credit and $150 million for a delayed draw term loan. This means they've significantly increased their borrowing capacity, which could fuel future growth or acquisitions. They also retired their old credit facility. Now, for my take, Consensus Cloud Solutions appears to be navigating a challenging market with a focus on its core corporate business, seeing growth there, even as their smaller customer segment declines. The substantial goodwill number highlights their acquisition strategy, but it's crucial for them to show that these acquisitions are paying off. Their strong operational cash flow is a real positive, giving them the firepower to manage their debt and invest in their business. However, the decrease in net income year over year, despite flat revenues, warrants attention. It suggests that while they're managing operational costs, other financial factors like interest or perhaps investment costs are eating into profits. The increased spending on stock buyback signals management's confidence in their own stock's value, which can be a good signal for investors, but it also reduces the cash available for other potentially growth-driving investments. The company is expanding its borrowing capacity, which could be a double-edged sword. It provides flexibility, but also increases their financial leverage. The slight uptick in customer churn, though small, is something to monitor, especially as they shift focus towards larger corporate clients. The increasing importance of their corporate segment compared to SOHO is a key strategic trend to watch. Overall, Consensus Cloud Solutions is a company in transition, shedding some of its smaller customer base to focus on larger, potentially more stable corporate clients. They are actively managing their capital structure by repurchasing debt and stock, and they've secured more credit for future endeavors. While profitability dipped this quarter, the underlying operational strength seems solid. Keep an eye on whether their strategic shift to corporate clients translates into renewed net income growth and whether their increased debt capacity is deployed wisely. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. And don't forget to check out the Discord in the description to keep the conversation going. Thanks for watching. See you next time.